Hey everyone. I keep saying in almost every other video that the market is different, the market has changed, and keep sort of blaming my losses on that. But that's true month to month. August was great. September sucked, and October has been a very mixed bag. But to me, there seems to be a more fundamental shift in the crypto trading space, at least over the last 2 to 3 years of my experience. Let's see what I'm talking about, and a possible way around it. I cannot speak for the very early days of crypto exchanges, but even 3 years ago, the market seemed, dare I say, organic. People were genuinely trading, buying, holding, selling, trying to outsmart each other, some manually, some with bots, some with simple, and some with complex algorithms. And it was somehow natural. And if there were weird things happening, they were usually tied to some event or announcement. But right now, I feel the best word to describe what the market looks like is manipulation. Take a look at this. I got liquidated here, and it looks like the situation was very specifically designed to liquidate traders like me. 1, 2, 3, 4, 5 shots at almost equal intervals with zero rollback and flat plateaus in between. And then this hair comb pattern? Nothing natural about that. Someone knew exactly what they were doing. I'm guessing it may be someone like this here at Whale Alert. Hundreds of millions of dollars are being transferred between exchanges and wallets every few hours. At those astronomical numbers, it would seem like a very easy job for a single person to throw in a few $100,000 here or there, drive the price to whatever level they want, take the profits, and go. And these guys know exactly how shots work. Very often, I see stuff like double shots. One first, and then another one in the same direction, leading to major squeezed stop losses. These hurt a lot. What's important is that in this zero-sum game, no matter what happens, someone makes money and someone loses money. It's just a matter of what side you end up on, unless you are the exchange, in which case you always win. So, what can small fry traders like me do here? This here is just a theory, but I think it's worth sharing. You see, exchanges impose certain limitations on how much the market can be manipulated, especially on futures. And one of those things is the risk limit. I talked about it in my liquidations video back in diary number 64, but to reiterate, every coin at any given leverage has a limit on how large a trader's position could be, and not only the position, but the sum total of all concurrent active limit orders. Let's take an example from ByBit futures list. Let's say XPL USDT. At the maximum leverage of 75, the risk limit is 5K. At 50x, it's 25K. At 25x, it's 100K. At 20x, it's 150K. At 10x, it is 700K. At 5x, it's 4 million, and at 2x, it is 10 million. So let's see how much actual margin one would need to have to max out their total position size. 67 USDT? Anyone can do that. 500? Again, pretty much anyone has that. 4K? 7.5K? Not everyone, but it's still conceivable. And here is a big jump. To max out the position at leverage 10, one would need 70K in real cash. At leverage 5, we are approaching 1 million in margin, and at leverage 2, we are at 5 million. So, my assumption is that if at higher leverage anyone can do it, then nobody actually does it. There's much more resistance possible to that from many other players in the order book. So then, reasonably, one would assume that a single actor with the desire and the resources to manipulate the price would do so at a level where there is no equal counterforce to their efforts. And that elite level starts at leverage 10 and below. So let's see what is actually happening in the order book at those risk limits. And let's stick to the buy side for now. I will use depth shots to demonstrate, and if you're not sure how they work, I have 2 very in-depth videos about their mechanics, so check them out if you like. Here I've set up a bunch of emulated depth shots algos, where each algo's quoted asset volume corresponds to the risk limit at a given leverage. Let's fire these babies up and see what it tells us. To make it easier to understand, I made the order size equal to the leverage for each risk limit. The 75 is as close to the price as it gets. The 50 is pretty much the same, as there is only a 20K difference. The 25 is at around 0.2%, which is at least discernible. Yeah, this is the reason I used emulation. I did not want to bet real money at distances of 0.05. Now, the 20 is at around 0.3%, still too close for comfort. And the 10 gives us a big jump to 1.5–1.6% distance. This is actually concordant with the point where we also have a big jump in required margin. The 5 is way down there at 16%. Makes sense. It would require almost $1 million in real margin to drive the price down that much. And the 2 is shown at 32%, but it's just the limit of how far the order book data is available. So there you go. We have connected 4 different factors into a coherent picture: the leverage, the risk limit, the margin required, and the distance in the order book. Again, what this means is that if a single actor wanted to instantly move the price of XPL down 1.6%, they would require 70K of margin at leverage 10 to max out their position size at 700K. Let's try a different coin. I have set up the same thing for ADA, so let's see. The higher leverage risk limits from 20x and up are all within 0.2% of the price. Now at 10, where the risk limit is 3.3 million, we move over to 0.6%. Obviously, ADA has way more volume and density in its order book. At 5, there is a huge jump over to 15% distance. Again, this is where the order book visibility ends with this coin. And looking at 2 doesn't even make sense. So, the risk limit corresponding to leverage 10 gives us a more realistic distance to trade at. I'm gonna let you in on a little secret here. ADA was one of those heavy coins that I used for my honey badger strategy at distances of 0.5 to 0.6%. And now I have pretty much a mathematical confirmation of why it worked. Now, these 2 examples were coins in their calm, normal state, meaning they are not too active. There isn't much active trading happening per unit of time. Let's take a different coin. The activity on Puffer at this moment is substantially above its normal state. So let's build up a set of algos. Its max leverage is only 20, so we start there at 5K risk limit. At 10x we have 100K, at 5x we have 200K, and at 2x we've got 1 million. Add the symbol here and let's go. 20x is at 0.2%. 10x is around 2%. 5x is at 5%, which is way lower compared to those other coins we looked at. And 2x is yet again beyond the available order book data. So, when a coin is in a more active phase, the order book seems to become more dense, and 5x is now not out of the question. What may also play a role is the absolute value of margin required. If for XPL one would need 70K of margin to max out at leverage 10, with Puffer it is only 10K of margin. So let's summarize my first theoretical observations. A single big actor may be able to reasonably and instantaneously manipulate the price to the level corresponding to the distance of 10x risk limit in the order book, maybe even 5x, but that's quite far away under normal circumstances. So, this is, theoretically, the maximum size of a single shot initiated by a single actor. Naturally, this is not an infallible law set in stone. First of all, the order book changes very rapidly, and Moontrader is only able to refresh it twice a second from what I know. Secondly, the order book does not show stop limit orders, which when triggered can suddenly materialize in the order book and throw everything off balance. Thirdly, the theory above assumes one actor with one sub-account. If the manipulator has 5 accounts and is able to execute orders in perfect sync the very same instant, they may get away with half the total margin required and do that at higher leverage than with a single account. Also, this falls apart if the manipulation is a concerted effort by several or many players, like when a coin is in a pump phase or it is being listed on another exchange with a major spike in activity. Then there is no telling what the shot size might be and how much instantaneous volume is possible. There's also the spot market that can influence the price on the futures, but that's a whole different story. But whatever the caveats might be, I believe that this theory is a solid baseline for selecting your settings in the depth shots algorithms for various coins. It is a long way from just guessing or from setting all coins to, say, 500K and waiting for things to start happening. The next step for me would be to put this theory into practice, and that's going to be a topic for one of the next videos. Until then, happy trading.